Hey everyone, Professor Stefan here. In today's video, we are going to talk about journal entries and try to give you a short refresher on kind of how accounting and the mechanics of accounting work. So let's get started. So our accounting process starts with the recording of transactions. Now, transactions are just things that happen in the day-to-day life of a business that are going to generate automatically journal entries for us. So this could be the payment of cash that gets captured by the accounting system, could be the receipt of cash, could be the shipment of goods to a customer that generates a journal entry for us. All sorts of things are going to generate entries that get captured in our accounting system throughout the year. Now, at the end of this year, we're going to add up all of these transactions, all the debits, all the credits across the various accounts, and that's going to give us an unadjusted trial balance. And that's kind of, before we fix anything up, that's sort of where things stand. Now, once we have our unadjusted trial balance, we're going to make our adjusting entries. Now, I often find students are kind of confused about transaction journal entries versus adjusting entries. Is there really any difference? And they're all journal entries, okay? They're all debits, they're all credits. The only difference here is the transaction journal entries kind of get captured automatically by our accounting system, while adjusting journal entries, these are the things we have to add in that might get missed by the accounting system. So we get to the end of the year and we say, you know, what haven't we captured yet? What do we still need to record? And we go put those things in manually in the format of an adjusting entry. So they're all journal entries, just one kind of gets captured automatically, and one we have to sort of fix on our own. So once we think we have all of our adjusting entries in, we're going to go ahead and create what we call our adjusted trial balance. And again, this is just adding everything up. There's nothing complicated about it. But that says, here's kind of our final balances in our accounts. Once we have that, we're going to create our income statement telling us how much money we made this year. And we're going to record our closing entries, which just moves our net income into shareholders' equity. After moving our income into shareholders' equity, our trial balance is done and closed, and we can create both our balance sheet and our cash flow statement. So let's start with the balance sheet. We have our balance sheet equation where assets equals liabilities plus equity. Our assets are just resources the firm owns that we expect to give some future economic benefit. Liabilities are claims against these assets that we owe to our creditors. So they say, hey, you owe some stuff, you're going to have to expend some of those assets to pay us back. And finally, shareholders' equity. This is always sort of the most confusing component, I think, of the balance sheet. And it's just residual claims on the assets. So if we took all of the firm's assets, we liquidated those, and we paid off all of our liabilities, whatever is left after all of that goes to the owners of the firm. Now, the income statement differs from the balance sheet in that it measures kind of the results of the firm over a period of time, where the balance sheet is a snapshot of kind of what are the assets and liabilities of the firm right now on a given date. The income statement measures performance over a period of time, so a month, a quarter, a year, something like that. And we have an income statement equation where net income just equals revenues minus expenses. And revenues are the inflows from our customers for kind of the services or goods that we provide. And expenses are the outflows we have to make to pay our employees, pay for materials, products, all that kind of stuff to more or less just run our business. And net income then is just the difference between those two. Now, there's an important relationship here between the balance sheet and the income statement that I think often kind of gets lost on students. And so if we take our balance sheet equation, assets equals liabilities plus equity, and our income statement equation of income equals revenues minus expenses, we're going to see that our income flows directly into the shareholders' equity. And so any change we make to revenues, any change we make to expenses, all of those are going to directly affect the balance sheet through shareholders' equity. And so always remember that. Something hits revenues, something hits expenses, it also hits shareholders' equity. Now, when we get into journal entries, we need to remember that this balance sheet equation has to stay balanced. So the assets always have to equal the liabilities plus equity. And our journal entries can affect different kind of parts of this equation. They could affect two assets, you know, debit and asset and credit and asset, could affect an asset and liability, a liability and an equity. All sorts of different ways these things can work together, but that balance sheet equation is always going to hold. So let's take a look at a few transactions and see how these things affect our balance sheet equation. If we buy some supplies on credit, that means our assets are going up, we're getting some supplies. But now we owe somebody some money, and so the value of the assets we bought is offset by the increase in our liabilities that we owe. If we received cash from an investor in exchange for common stock, well, our assets went up when we got the cash, but so did our shareholders' equity. Balance sheet equation remains balanced. If we received cash from a customer to whom we'd previously sold goods on credit, so now they're finally kind of paying off what they owe us, well, we received cash, so our assets go up, but also the accounts receivable, what they owed us, goes down. They don't owe us money anymore. So this kind of transaction only affects the asset side, but because it's offsetting in assets, our balance sheet equation remains balanced. So let's say we received an electricity bill for the electricity we used in the last 30 days, and now we owe the electric company, $100. Well, our liabilities are gonna go up because now we owe somebody, and because we used up this electricity, that's gonna create an expense. And as I talked about on a previous slide, remember our revenues and expenses always go directly into shareholders' equity. So when we have an expense, our shareholders' equity, kind of the residual claimant to the owners, goes down, right? We made less money, so the equity goes down. And so our liability increase is offset by our decrease in equity that comes through the income statement. Now, when we actually record these transactions, we're gonna have debits and we're gonna have credits. And if we make one of these little T accounts here, our debits are gonna go on the left side and our credits are gonna go on the right side. Now, why is that? Completely arbitrary. So I know some of you get frustrated with accounting that it's this kind of closed arbitrary system. Nothing really makes sense, and that is completely true. Unfortunately, it's a system that we have to learn for this class. So some of these conventions, you just got to do as many practice problems as you can, and eventually it's going to get kind of, ingrained in your bones and you're going to feel okay about it. Now, our general rules. This is the stuff that you kind of just have to memorize. Our debits are going to increase our assets and expenses, and our credits are going to increase our liabilities, our equities, and our revenues. Again, this feels very arbitrary if you're not super comfortable with accounting, but kind of just take this as 5 things you have to memorize. These are kind of 5 key components of what the normal balances of these accounts are. And when I say normal balance, that just means what makes that account go up. So our asset normal balance is a debit, where debits make it go up. Our liability normal balance is a credit, where credits make liabilities go up. Equity normal balance is a credit as well, so credits make equity go up. And then remember, equity kind of gets some flow through from the income statement. And so if our equity goes up, that means our revenue went up. So revenue is also a normal credit balance. Credits will make revenue go higher. And expenses are the opposite. Expenses make our equity go down. So they have a normal debit balance. So let's take an easy example here. Let's say Morrowind Corporation issues 5,000 shares of stock for $100,000. Well, we know our assets go up because we're receiving $100,000 in cash. So we're going to debit cash for $100,000. And our equity also goes up because we issued common stock. So kind of the owner now has a claim against some of our assets. So our equity goes up by the $100,000 as well, the common stock account. Now you're going to see how I write journal entries. I add this little B-A or this B-E that you see here. That's just trying to point out where on the balance sheet or the income statement this goes. So the B indicates balance sheet, the A indicates assets. So cash is a balance sheet asset account. For common stock, the B indicates balance sheet, and the E indicates equity. So common stock is a balance sheet equity account. And we're going to see the same with income statement revenue, income statement expense, and balance sheet liability. So this is just kind of a quick summary slide of how these T accounts work. Remember, for our assets, we have a normal debit balance, which means debits are going to increase my assets and credits are going to decrease my assets. Now on the liabilities and equity side, we have a normal credit balance. And that means credits are going to increase my liabilities and equity, and debits are going to decrease my liabilities and equity. And so this is just a nice little reference slide if you kind of forget where things are supposed to go. So closing thoughts here. Your journal entries are going to affect some part of the balance sheet equation, where if you have revenues, expenses, remember those go into shareholders' equity. Now journal entries can contain both balance sheet and income statement accounts in all sorts of different combinations. So you're never going to be kind of restricted to any single thing. And the thing you need to memorize here are the normal balances of these accounts. So what is going to make my asset go up? What's going to make it go down? What's going to make my revenue go up? What's going to make it go down? And these feel arbitrary. They're kind of frustrating to work with at the beginning if you struggled with kind of the mod where you were first introduced to this. But now is your time to get caught up. There's 5 of these you need to remember: assets, liabilities, equity, revenues, and expenses. Remember those 5, and that is going to set you up nicely for the rest of the class here. Thanks for watching.